Today, we're going to break down what a stop loss is and why this tool is so important for every trader. In this video, you'll learn how a stop loss helps limit your losses, when to use it, what types exist, and what mistake beginners make that can cost them their entire capital. Stick around until the end to find out how to avoid being stuck with worthless assets during a market panic. Don't forget to like the video and subscribe to the channel. A stop loss is an order that triggers when the price of an asset hits a certain level. Its main job is to automatically sell the asset if the price moves against you, limiting your losses. Here's a simple example. You buy a stock for $100. You decide you're willing to risk no more than 5%. So, you set your stop loss at $95. As long as the price stays above that, the order just sits there. But the moment a trade goes through at 95, your stop loss kicks in and starts selling. You don't have to do a thing, the system handles it. And that's the key benefit. A stop loss brings discipline, removes emotions, and works on autopilot. But that's just the tip of the iceberg. How a stop loss works in real-life trading and why the type you choose matters is what we're going to talk about next. Not all stop loss orders are created equal. There are two main types: market and limit. A market stop loss sells at the best available price as soon as the trigger level is hit. The upside? High chance of execution. The downside? No control over the price. If the price suddenly crashes from 96 to 80 in a second, you sell at 80. The panic fades, the price bounces back, but you've already sold at the bottom. Join our Telegram channel for updates on new videos and articles. You'll find the link in the description or the first comment. A limit stop loss is a bit smarter. It not only triggers at a set price, but it also includes a minimum price you're willing to accept. For example, it triggers at $95, but you only want to sell at 94 or higher. If there are buyers at 94 when that happens, the trade goes through. But if the market crashes so fast that the next price is 80, your order doesn't get filled, and you're stuck holding a rapidly falling asset. That's the double-edged sword of a limit stop loss. More price control, but a bigger chance of not exiting the trade at all. The market isn't a place for stubbornness. Trading without a stop loss can trap you in your own hopes and illusions. This is especially risky for beginners who think they'll always be able to close a trade manually. But in reality, panic, sudden price moves, connection delays, or technical glitches can take you out of the game. The system, on the other hand, doesn't hesitate. It executes the order instantly, without emotion. That's the true power of a stop loss. It removes human error from the equation. But it's not all black and white. Ironically, one of the most popular types, the percentage stop loss, can lead to losses. That's when a trader mechanically sets a stop loss at 5 or 10% below the purchase price. The issue? The market doesn't care about percentages. It moves according to its own rules, and it often takes out those orders just because they're too obvious, especially when the stop loss sits right at a level that most traders can see. It gets hunted, and then the price goes in your favor, but without you in the trade. That's why smart traders rely on actual price levels, support and resistance, previous lows, or technical indicators, instead of random percentages. For instance, you can place a stop loss just below a consolidation zone or the lower boundary of a chart pattern. This reduces the chances of being stopped out for no reason and increases the success of your trade. A pro follows a system, not a guess. There are also more advanced orders, like the trailing stop loss. This is a dynamic order that automatically follows the price when it's moving in your favor, but locks in profits when the price reverses. Imagine entering a trade at $100. The price goes up to $130. You want to protect your profit, but don't want to exit too early. So you set a trailing stop loss with a $10 trail. It moves up with the price as long as it rises, but if the price drops to $120, boom, it triggers and locks in your gains. But even a trailing stop loss isn't perfect. During sudden news events or low liquidity, a price gap, a sharp jump or drop can happen. In those moments, your order may be filled way below your intended level. This applies to both market and limit orders. So you have to choose, do you care more about guaranteed execution or about controlling the price? Another key point is the size of your position. A large stop-loss order might not be fully filled if there aren't enough buyers or sellers in the market. That's called slippage. That's why experienced traders break large positions into smaller parts and use partial exits. For example, they might sell 1/3 when the first target is hit, another third at the second, and so on. This gives more flexibility in managing both risk and profits. We've published a new article on our website. You'll find free resources about stocks, bonds, and ETFs from beginner to advanced levels. Check it out and don't forget to bookmark the site. Just as important is the volatility of the asset. For some assets, a 3% move is a big deal. For others, it's business as usual. Blue chip stocks tend to move slowly, so you can use tighter stop losses. But cryptocurrencies or tech startup stocks can swing 10% up or down in an hour. A tight stop loss in those markets is pretty much guaranteed to get hit. So, traders need to adapt their strategy to the specific asset they're trading. Sometimes traders use time-based stop losses. That's when you close a position after a certain period, not based on price, but on time. For instance, if the price hasn't hit your target in 3 days, you close the trade manually. This protects you from trades that get stuck and start draining your mental and financial resources. There's also the concept of a smart stop loss, one that triggers not just based on price, but on multiple conditions. For example, a moving average crossover plus a break of support. This requires software or hands-on monitoring, but the precision improves significantly. Some say that using a stop loss shows weakness, that a confident trader doesn't need one. That's a dangerous illusion. The market doesn't forgive overconfidence. Even the most solid analysis doesn't guarantee success. A stop loss is like wearing a helmet on a motorcycle. Sure, you can ride without it when everything's fine, but one day it could save your head or your capital. Leave a like and subscribe to the channel. You can support our content on our membership platform. The link is in the description or pinned comment.